Dan, I have to ask you, what is the yield advantage? Why is it so important?
Sure. So, fixed income's less complicated than other investment pursuits. When you think about high quality fixed income in particular, the starting yield is usually a reasonable floor on what you'll earn over a multi-year period. And a few years ago, there was no yield. Inflation was better contained, but yields were incredibly low, both in nominal and real terms. Today, you have very attractive starting yields, even in a relatively uninteresting passive benchmark like the Bloomberg Aggregate Index, where you can generate a yield of above 5% and where you have a 95% correlation between starting yields and 5-year forward returns. When you add some active management, when you expand your opportunity set into sectors that aren't represented in passive indices, you can quickly take advantage of tremendous additional opportunities and get that yield up into the 6 or even 7% type range. So don't make it more complicated than it needs to be. Be patient, have a long-term focus, and take advantage of, again, this yield advantage that we're talking about this year.
I like it. Don't make it more complicated than it has to be. Rich, there's still a lot of inflation volatility. Yeah. So what's our view on inflation, and how should investors think about inflation protection?
Well, our thesis last year, at a time when we had our forum 13 months ago, inflation was running somewhere between 4 and 6% in the US, the UK, and the Eurozone. And although our thesis was it would come down, I don't think we were sure it would happen so rapidly. Central banks have largely succeeded by raising rates into restrictive levels to reduce inflation. So they have a lot of room to cut eventually as inflation comes down or as economies soften. And I think part of the proposition now is investors finally are getting compensated for that with these positive real yields, not only for nominal bonds, but inflation-protected bonds, which are at levels, again, that we haven't seen in 15 plus years.
We've seen this generational reset higher in yields, and what's great now is that there are bonds outside of the U.S. that look attractive. This is also, we're in London. It's great that you can get higher yields in Europe. Can you describe the opportunity across both the developed world and emerging markets?
Sure, and that's another key theme coming out of our secular forum, that there's great value outside the United States. The U.S. economy is strong. A lot of this, we think, has to do with technological innovation, the fact that during this post-COVID cycle, households in the United States have locked in very, very low 30-year fixed mortgage rates. Take a look at other high-quality markets outside the United States, very attractive starting yields, particularly in U.S. dollar hedge terms. You have situations where there's more economic fragility outside the United States, perhaps less dynamic economies, household sectors that have floating rate mortgage markets, floating rate consumer debt markets that appear to be weaker than the United States, and more fiscal responsibility outside the United States, with many developed market governments running close to a balanced budget, or at least deficits in the very low single-digit type areas instead of mid-single digits in the United States, despite considerable U.S. economic strength. So we think global investing's back, and that includes higher quality areas of the emerging markets as well. Very high nominal yields, very high real yields, governments and central banks that have been, in some sense, a bit more fiscally responsible, a bit more active in the inflation fight, a bit, again, earlier than developed market central banks, where we think there's not only attractive starting valuations, but we likely live in an economic environment in future years that can be favorable to certain segments of the emerging markets as well.